All right, so let's begin our very special segment, Meet Your Fund Manager, where today the category in focus is aggressive hybrid funds. Hybrid is a very large category where, as per your risk appetite and the kind of exposure you want to have in equity and debt, you can align your portfolio by having the right kind of hybrid category fund. But then today the fund in focus is of a very aggressive hybrid category, and we'll be talking about ICICI Equity and Debt Fund, for which I have Mitul Kalavadia, Senior Fund Manager, ICICI Prudential AMC. Mitul, good evening and welcome to the show. And while we will the nitty-gritties of these fund, but then before that, I want to really understand your take on equity markets, the way it's shaping up today. We had the first day of the week, and it wasn't a very optimistic start. We have entire day where we have crucial data coming in from the international markets. What is your view on the markets ahead?
So a couple of points to look forward to. There are a few positive things for the economy to look forward to. So the monsoons improving is actually a very good thing if one were to look at. It could have affected the Rabi crop more than the Kharif ones, but now at least with this improved monsoon, things should be fine in the second half. Coming to the areas of concerns, if one were to talk about, then it could be the rising crude price, so it would have some pressure on the currency due to rising trade deficit. And more importantly, if you were to think about that, if it remains here, then it might still not be a big negative impact. But whether it will stay here or it will go up, crude is a commodity which is very difficult to predict where it will really end up, because there is not just a fundamental demand supply side, but there is also what you can say a geopolitical angle which plays a significant role there. So we would prefer to take it as an input rather than trying to predict it and then base everything out of it. As of now, it's not a big negative, it's a marginal negative, but that's one area of concern to keep it in mind. The other areas are the rates. How will the global rates behave and what are the global risks? From the global risk side, maybe the US commercial real estate is one area, another where there can be some risk, but there has been a lot spoken about or talked about. So maybe there has been a good amount of time available for things to get corrected there. Coming to the most important reason which I feel one should actually focus about and very less gets talked today about it is the valuation per se. If you look at the overall market valuations and different pockets of markets of valuations, then there is a lot more discomfort because the valuations are getting pretty expensive on many of the pockets. And if the rally continues in the market the way it has been very sharp today, if it continues for longer, then it would get into a zone which will be more frothy. Already there are certain pockets of market which are getting frothy, but its overall markets still on the large cap sides are still okay. But when you look at some of the mid caps, small caps, and some of the micro caps, those are where there is a slightly area of concern, and one should be cognizant of this. See, once,
Right.
whenever.
Right. The coming quarter earnings, you think that's going to set the mood going ahead in the festive season? I want to elaborate more on that point where you highlighted that mid cap and small cap is slightly a sticky zone right now, and large cap being more comfortable as far as valuations are concerned. But then before that, I want to understand your view on corporate earnings and the way it is going to set the tone of the markets in for coming months, especially considering the festive season.
Sure. The consumer festive season demand side seems to be okay. So most of the areas of consumption related should do well. Maybe Q2 in terms of numbers may not be so much, but Q3 is the one where the actual festive season demand would really play a big role. And that seems to be at least shaping up in a good way. We are getting early signs from some of these consumption companies which suggest that things have already started to improve at the margin. Now, whether that momentum continues or not, but whether the results of this quarter will be great or not, actually the commentary, I think, from the managements would be more optimistic, and that should allow some of these stocks to deliver. Coming to the other set of stocks in the market, So hotels, again, part of consumption that should be okay. But when you come to industrials, cap goods, autos, or IT, metals and all, broadly, we have not come across any areas where there will be a big concerns on the earnings going forward. Banking is one where people are worried whether we are at the top of the cycle and whether the margins will get squeezed going forward. There might be something, but already the expectations are also set there. So it's not the earnings which would be a major worry in the near term, at least from this quarter point of
Okay. We also to talk about the fund in specific over here, equity and debt fund. But then before that, just a small questions on large cap valuations and how uncomfortable do you think is the mid cap, small cap space for you now as a fund manager?
view. In terms of valuations in the mid and small cap side, they are expensive. But is it that the whole basket per se, is it into a really frothy zone? The answer may not be yes. We have some internal models which suggest the kind of some kind of a sentiment indicator in terms of market caps. So the market caps of aggregate between large and mid cap, mid and small cap, when you see, they are closer to all-time highs, and that should talk about a lot about the sentiment of the investors in the market. People think that also if you combine it with the flows that you get in the mid and small caps, that both set the tone saying that this is one area which everybody thinks is going to make a mega money in the long term, and that's why maybe people are ready to let go of the short-term returns because when the valuations are expensive, if you have you are trying to borrow some part of the future returns today. So that's the short take. I think some of the sectors or some of the stocks are getting into a zone where some of these cyclical names are trading at some of the valuation similar to a stable or a secular companies, and that's the area of discomfort because the earnings longevity may not be so long, and then those valuations may not sustain.
Mitul, now let's talk about the equity and debt fund that ICICI Pro has. And very basic question, I want to start this interaction and we'll go in depth with about the fund strategy and exposure also. But then talking about the specific category in focus, what kind of investors do you think should be aligning towards these fund or should have this kind of an exposure or fund in their portfolio as far as their long-term goals are concerned?
Sure. Actually, it's suitable for investors who have a slightly longer horizon of time. Somebody who has, let's say, a 10 or 20 years of horizon, somebody who is in their mid 30s or early 40s and has another 20, 25 years of their work life for them to generate their savings. This fund suits them because they have a longevity to stay invested. The way we run our fund is based on three sources of creation of alpha. So we don't try to be static fund on the large cap, mid cap allocation. We try to be more dynamic. At the same time, we also try to be dynamic on our cash levels in the fund. And that should allow the investor to do a auto check on their allocations, on their allocations between all both the categories between debt and equity and large cap, mid cap, small cap. So we do it for them within the fund rather than they trying to do it themselves. I think that's the whole purpose of the hybrid as a category.
Right.
And
So the
that's why we
question and concern with this kind of a strategy that you as a fund manager adopts is basically how is the exposure aligned in equity and in debt, and talking about the exposure, how risky or how less risky the fund becomes for an investor.
Sure. See, in terms of allocations between the cash, and there is some kind of a cash model that we have along with our other hybrid funds where we use something similar there. Based on that, we keep gradually changing our allocations between debt and equity. At the same time, in terms of risk, one were to talk about, markets inherently are volatile. So there are always, and it's also driven by sentiments. So markets tend to go into extremes on both the side. and it is very difficult to always predict when it will happen. So frankly, we might be uncomfortable with the valuations today on mid and small cap, but that doesn't mean that the rally has just ended and tomorrow is the fall. That's very difficult to predict. All you can do is try to plan for it. All you can do is try to get yourself ready for it. So it's better to be prepared when the corrections comes. They are very sharp and then they are very brutal. It's better to be prepared, and the best way to prepare yourself is by being systematic about it rather than trying to be more emotional about it and trying to catch the momentum there. It's very difficult to catch the momentum. So that's what we try to do. We try to be more systematic. Slowly, in the past, if you look at our fund between 2018 to 2020, systematically we increased our mid and small cap allocations in the fund. That benefited over the rally for the rally from 20 to 21 and some part of 22. And then we had again reduced some part of our mid and small cap allocations out there, which helped us to protect a lot of alpha between 2021 and 22 when the suddenly the crude spiked and due to Russia war and the inflation became a concern and rates started to rise.
Right.
It helped us during that time.
Okay. Mitul, if you could just reiterate on this point as to how much is the equity and debt allocation right now in the fund?
Sure. So it would be somewhere around 67, 68%.
Okay.
That's what number would look like.
Okay. Also, going in specific with your equity exposure, what's the market cap exposure in terms of percentage?
A large part, so somewhere around mid and small cap should be less than 10%. So something around 7-8% is where we are in mid and small cap put together. Rest all is the large and the super large.
So, considering the kind of run up that one saw in mid cap and small cap, you think that the fund missed that rally and the kind of profits an investor must have got because you have a very restricted exposure in mid cap and small cap?
See, these are always tricky. So, like we had our set of mid and small caps which did participate. We had some of our thematic calls or the counter cyclical calls also work for us. So that has actually made up for some part of the mid and small cap rally which has happened in the near term. But these are things. What we have seen is that it is better to stick to the model that we had. The model helps you over the longer period of time. In the shorter term, it might look like that you are missing the point, but frankly, it is more important to be systematic rather than trying to get carried away by the momentum. And it's difficult to really change course when things really change in the markets. You could have seen it in the last. There was in the last week. There was one day with a very
Right.
sharp, and it would have been
Right,
very
which is
difficult
why
to
it's
predict.
always advisable to have a longer term strategy as far as having an equity exposure is concerned, and even if it's an aggressive hybrid category. But having said that, you have large and super large caps in your portfolio. Across market cap, sector wise, what's the allocation? Where are you heavy and where are you right now less than average, which you think might be extended in coming months?
So our top sectoral ideas which we like is power. Then we have auto, telecom, oil and gas. These are the top large orbit ideas where we are more positive. And our approach while investing or looking at sectors is more like a counter-cyclical and being contrarian. Along with that, we also try to do a bit of a bottom-up stock picking. So all these three combination allows us to create this portfolio. We have been positive on power for the last 3-4 years now. The reason being that the sector has gone through a long cycle of downturn, and we are headed for a good 3 to 5 years of an upcycle. This sector actually has a cycle which is longer in nature than the general other sectors. Apart from that, we feel that the telecom as a sector is a good consolidated sector. It's also one of the cheap way of playing for consumption stocks. Uh, then coming to auto, auto is more bottom up there. you have to get the model cycle for the companies right. You have to understand what companies are going to do and how their market shares are going to change over the medium term, over the near term, and then accordingly look at stock ideas. And that's what has helped us. In fact, auto is such a wide sector that there are wide varieties of styles that you can apply there. There are some turnaround stocks where there is a balance sheet repairing going on. You can be invested into those. And what we have seen in the past on metals name, when there is a sharp reduction in debt, there is a good amount of equity upside which happens. Something similar names are
Right.
possible
Right.
auto on the investment side.
Right.
Similarly,
Right.
as are also there.
Right. So, given the current scenario and given the current interest rate scenario, how are you placed in debt? How long or how short are you placed in debt? How is that part of the fund playing out for you?
So we don't have a very high durations currently. So duration side is lower, uh, given where we are in the cycle on the rate side.
All right. Now, considering this kind of a fund also has more equity and less debt exposure, in order to place this fund in your portfolio, what should be your other references in the portfolio? In the sense, how can you align it with your entire equity exposure and with your entire debt exposure? You know, not going over diversified in either of these categories, because you have an aggressive hybrid fund which is slightly large cap biased. Okay, would you recommend an investor that if at all they have a fund like this in a portfolio, they might want to focus on other exposure, other funds that give you better exposure in mid cap and small cap, and maybe an entirely debt oriented fund? Do you think that's how a portfolio can be built if one has ICICI equity and debt fund?
Actually, that may not serve the purpose. The reason for having slightly lower mid and small cap today is based on the expensive valuations. So if one tries to buy ICICI Prudential equity and debt fund and then goes and buys mid and small cap separately, then actually it might look like a prudent thing to do from a overall allocation point of view, but given where the valuations are, may not be the right strategy to do. The reason I would say, in fact, a good allocation to our fund can be made so that then you don't need to actually go and do the separate allocation to mid and small cap in that sense. And then when there are times like between the 2018 to 20, market invariably goes through such cycles of poor returns in the mid and small cap. We did had a higher allocation of mid and small cap into our portfolio then. So that's how we try to be systematic. It's the way to put position is that instead of one trying to do the allocation between various categories on their own, one can actually allocate a large proportion of the portfolio to this fund and be invested for a longer horizon. And that's when you actually tend to benefit from the market cycles over a period of time.
Got it. All right, Mitul, thank you so much for being on the show today and helping our viewers with the market movement ahead and also the kind of strategy you are opting for the fund. Thank you so much.
Thank you very much.
It's time for a quick break, but then before that, we at the Times Network bring to you Mirror Now Summit Chhattisgarh, which will be held on Wednesday, 20th September 2023 in Raipur. As India's most influential news network, Times Network channels have been catalysts for change and action for a better India, with the theme Path to Progress. At Mirror Now Summit Chhattisgarh, we aim to showcase the journey that is leading the change in the sustainable agriculture revolution and enhancing farming methods for economic growth. Chhattisgarh's commitment to enhancing healthcare is evident, with a focus on accessible, high-quality medical services for a healthier future, and highlight the state's rich cultural and natural heritage. At Mirror Now Summit, we will discuss and deliberate with state leaders and authorities to define a holistic development agenda for the entire state. So get ready to catch all the action here on the Times Network. Welcome back. You're watching The Money Show with me, Kavita Thaplia. Now, how can employees seamlessly transition from a group to an individual health insurance while you continue your company's health insurance policy, and that too after getting laid off? To discuss more on this, I have Amjad Khan, Executive Director, Employees Benefit Practice and International Businesses, Anand Rathi Insurance Brokers. Amjad, good evening, and once again, welcome to the Money Show. Today, we are going to discuss about a very crucial topic, and that is having a group insurance policy provided by your employer, and how can you continue those benefits even after being laid off, or maybe if you quit the company. But then, just for starters, Amjad, I really want you to help our viewers understand the kind of medical coverage they get through their employers. Okay, the corporate medical covers that they get, what all is covered and what all is not covered. Because what happens is, we know a lot of people, in fact on the show I get a lot of questions where people say that the only medical insurance cover that they have is through employers. They don't have anything personal in terms of medical coverage. So what are the advantages and disadvantages of having a medical coverage from your employer?
Okay, good evening, Kavita. Yes, I think a very relevant question, especially post-pandemic. We all have seen how the importance of medical insurance has grown up. And I think everybody in today's time wants to have a medical insurance at all point of time. But before we move on to the portability side, I think it's very important for us to understand that while there are advantages for a group health plan given by the employer, there are some disadvantages too. So first we look at advantages, like why is it pertinent to have a group health insurance, right? Because that's one of the most important benefit which any employer will provide to its employee. So I think the biggest differentiator there is, since it is a group cover, there is no medical health checkup required, and pre-existing conditions are covered from day one, and there are no waiting periods. So broadly, these three benefits are the reasons why group health insurance is a lucrative option, rather a must-have option for all employees, right? But there are a few disadvantages as well, which we need to understand on the group health side. One of them is there is no control from an employee level on the benefit structure which you would want to have for yourself, since it is uniform across the organization and the decision is taken by the employer. Secondly, if you leave your job or you're laid off, or probably one day the employer decides not to have the medical insurance as a benefit structure, so there is no benefit, there is no health benefit which the employee has at that point of time. So there is a gap of what if, right? So that's another vulnerability which on a group health insurance which we have. Second and last, one important point is everybody is paying the same premium. Even the healthier employee or employee with pre-existing condition, everyone is paying the same premium. So these are broadly three disadvantages which we got to look at and understand in a group health plan before coming to the topic of portability.
Sure, exactly. So while it is important for an employee to have a medical coverage from their employers, and even if you have not enrolled, it is important for you to get yourself enrolled. But apart from that, you must have an individual health coverage or a personal medical plan for yourself and your family. Now, having said that, let's consider a case of porting the policy. How does that happen? You know, your association with the company ends. Maybe you are laid off, or maybe you've resigned. Can this benefit continue? Can a group insurance policy that you might have got yourself done by your employer get shifted or translated in an individual cover?
So yes, Kavita, I think the regulator in the year 2016 under the health regulation came up on this portability guidelines, which basically empowers an employee to carry forward his benefit on the group side to a retail policy in case of change of job, or maybe he's laid over, and all those examples. So in such scenarios, the benefit can easily be moved on to a retail health plan through the portability benefit clause released by the regulator. Now, what happens is the biggest advantage of portability is that you have continuity of coverages. So that simply means whatever coverages you had in your group health plan, more or less similar coverages will move on to our existing individual plan with the same insurer. That's the only rule. That's a critical rule which we have to follow, that your portability will happen only with your existing insurer.
All right. So while you are porting this plan, what all the things that you need to keep in mind? Because first, definitely, Amjad, the premium cost that you need to keep in mind, and also the kind of policy you are porting yourself into. Are you porting? Can you port from a group plan to a family floater? Can you also port from a group plan to an individual health policy? How do you decide all of these things? You know, because these are important decisions. You have to look at various factors. Your premium that might just go up if at all you increase your coverage, or the kind of things that you might want to, you know, get covered in the new health plan, what are the things that one needs to keep in mind, and what could be the right decision for them, you know, getting an individual plan or a family floater? What are the criteria to decide that?
So, Kavita, a very important rule under the portability clause is we got to understand that your benefit structure and the coverage will be a mirror while you're porting it. When I say mirror, that simply means if in my group health policy, I'm covered with my spouse, 2 children, and 2 parents, the portability policy will also have these 5 dependents. You can obviously reduce a few of them, but you cannot add. Right? For example, another example under portability is if under the group health plan, if your sum insured was 5 lakhs, that sum insured would be ported as 5 lakhs only. You cannot increase that. Although, yes, you can increase that, but there'll be a fresh underwriting for the additional limit which you want to do. So what it essentially means is whatever is your benefit structure, whatever are your benefit clauses, that would be mirrored as a similar thing under your portability clause. So that's one thing in mind. Second thing, very important, we have to take care while we are looking at portability is, see, portability, there's a small rule with the insurance companies want the policyholders to follow is timely intimation. So whenever a person resigns, he usually has a notice period of almost 30, or probably 60 to 90 days. What insurance companies expect is that they should be intimated at least 45 days in advance in case an employee wants to have his policy ported to a retail plan. So that's one thing which we all need to take into consideration, that between 30 to 45 days, we should ensure that the communication has gone to the insurance company regarding a need for a portability benefit policy under a retail plan. Second important thing is you have to understand what is your current benefit structure under the group health plan, because that's very important so that you carry forward the similar benefit structures whenever you port the policy. Like one of the most important benefit, as we discussed before, was a pre-existing condition that's waived off. There are no waiting periods. So these are very, very relevant benefits which we have to understand while we look at portability. Yes, as I said, the waiting periods are critical. So we have to understand what's your current benefit structure looks like. Third is has to be there could be a medical checkup which the insurance company might ask. It would depend on your what is your age, what has been your claims history. So if there is a health checkup which the insurance company wants during the portability, you'll have to go through that as well. And then there is your submission timelines regarding your documentation. So there is a portability form, there is your address and ID proof, and there is your claims history which comes from the previous insurance company. You fill up that form, submit it to the insurance company, make the premium payment, and that's when the policy will be issued by the same company within 30 days of time. So that's how the portability works.
All right. If you could just give an approximate increase in the premium amount that a policyholder might have to go through.
So yes, these policies will definitely be slightly expensive than your group health plan. Probably the increase in the premium could range anywhere between 10 to 100% of what your premium was under group health plan. There are reasons behind this, because for an insurance company, this individual is coming out of a group and getting into an individual risk, right? When the risk is spread across a larger group, obviously it's a safer risk for the insurance companies to underwrite, and that's why the premiums are low. But when that individual person comes out of that group and forms a single policy, that's where it is an individual risk. And that's precisely the reason why the premiums would be on a higher side. Secondly, if your age is around 45, 50, that's a high risk profile for the insurance company. In the last 2 years or 1 year, you have a claims history. So that will also add up to the cost. So all these factors taken into consideration, the insurance company decides on what would be your premium when you port into a retail policy. But usually it will be higher than the group health plan.
Okay, one last question and then we'll wrap up the discussion. If in case you are laid off, any problem in porting the plan, or it will be as easy as you quitting the company?
So Kavita, it won't be an issue because, as I said, health regulations released in 2016 empowers the employees for portability benefit. So even if you're laid off, you can look at the portability clause, and at the entire documentation and operational process, which I mentioned before, it would be the same. Except that in case of a resignation, there will be a resignation letter. In case of laid off, there will be a communication coming from HR on the emails of the employee. So those will have to be produced to the insurance company to put you into that bucket of laid off or resign. Rest, everything remains the same.
All right, Amjad, thank you so much for being on the show today and helping our viewers with health insurance portability and giving them a complete guideline of how to go about it. Thank you.
Thank you, Kavita.
All right, time to slip into a quick break, but then post that, we'll be having viewers on the show. answer all of their questions or their portfolio related questions, I'll be joined by Anil Rego after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. There are plethora of funds available in the market to invest your hard-earned money in. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at? To help you navigate through this maze, we have Anil Rego, founder and CEO, Right Horizons. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. Hi, Anil. Good evening and welcome to the show. And Anil, we also have our first viewer connected with us, Shashi from Bangalore. Hi, good evening, Shashi. How are you doing?
Fine, madam. Thanks for taking up my question. Thumbs up to the show as well as to the anchor.
Thank you so much for sending us your question. And as I can see, you have invested a lot in equity and you have large cap, large and mid, flexi cap, small cap, contra, even ELSS in your portfolio for wealth creation. And you've also invested in a way where you have taken care of inflation. And with this money, you also want to travel or you have traveled abroad?
I want
Is that
to travel.
a goal?
I have traveled,
you want
but
to travel.
I want to travel in a big way. Yeah.
That's exciting. And you have invested about 10% in 5 schemes of small cap. You have all small cap, Canara Bank, Kotak, Nippon, SBI and
Yes,
Axis,
yes.
right?
Yes.
All small cap.
Yeah.
Okay. And out of that, you know that you want to exit a few schemes. You just want to understand which one to retain and which to actually let go of. Okay.
Yes.
Okay. So a bit of structure I want in your question, where I want to understand. So far, you've just talked about the small caps that you have in your portfolio. But what about the large and mid and flexi caps and mid caps that you have? And contra also, could you name those funds? Because Anil will be able to guide you in terms of exits if needed from that funds also.
The large cap, I have Canara Bank equity blue chip. Then Mirai Asset large cap. Then large and mid cap, I have Axis Growth Opportunities. Then I have this Mirai Asset Emerging Blue Chip, Kotak Equity Opportunity. Then Flexi Cap, I have Parag Parikh, HDFC Flexi Cap and PGIM Flexi Cap. And then mid cap, I have Kotak Emerging Equity and PGIM Mid Cap Opportunity. And small cap, I have this 5. And ELSS, I have Mirai Asset Tax Saver and the Canara Bank Equity Hybrid. Equity Tax Saver.
Okay. I think that. And what's the current amount of investment? Like your total investment or SIP, that's what if you've done?
Roughly, it is upwards of 4 CR.
Right now, it is 4 CR. Okay.
Yeah.
I just wanted to understand, is this a portfolio from which you will be withdrawing money for your regular income or as a regular income?
Right now, it's not required because the pension I am getting is more than double the monthly expenses which I make. But in due course, I may reach a stage where inflation may take over. So that is the time I may require to withdraw through SWP.
All right. Okay. What's the amount that you need to travel abroad? Just a ballpark figure, if once or twice in a year you might want to.
More than 1 CR.
More than 1 CR. Okay. All right. First of all, I think I really want to congratulate you because looking at your age and the kind of equity exposure you have, you are an inspiration for all those people who think that, after 60, equity as an asset class is very risky and one should really not go ahead with it. I think, hands down, you really win that kind of a mindset. And I'm sure Anil also would agree to that. Anil, your observations?
Even I was about to start off congratulating Mr. Shashi. So first of all, he's able to build up a good corpus for himself and not miss out on, having his travel plans and setting aside a whole crore out of this corpus probably, for his travel plans. So I think congratulations. Coming back to, I think from the funds that you came across, I believe a number of them sort of are good funds and one can continue. But my only point is around, there are too many funds, right? So ideally, you can have, in the large cap, for example, you can just have one fund, and similarly, only when you go towards, say, small caps, you can have two instead of one, and possibly caps as well. So I think that is a little bit of discipline that, you could sort of look at, because over diversification also doesn't help. It will only add to your, burden of administrative side. Coming back to the specific question that you had, because yes, I think interestingly, it's in the similar line that you have about 10% invested into the small cap space. So that is good that you also have the discipline of saying not getting carried away, by the rally in small caps and putting all money towards it. So you are, especially since, say, you are on the retirement side, I think having this discipline is good. So from, the schemes that small cap schemes, right, that you have, Canara Robeco, Kotak, Nippon, SBI, and Axis, you have requested for, if we can shortlist two funds so that you can exit, the others. I think from the list, I like Kotak Small Cap and Nippon India Small Cap funds. I think both of them have been doing sort of reasonably well. And yes, having two funds, I think in the small cap space is okay to do. But I think, just go ahead and see how you can simplify your portfolio even beyond the small cap space, and possibly keep these two funds.
All right, that's the suggestion coming in from Anil. Shashi, is there anything you want to understand further from Anil?
Just one question, whether I should hold on to the Axis growth opportunities in the large and mid cap fund category.
Okay.
So if there was one fund that came to mind to say, you can drop, that's the one. Right? So as you go by, right, you will realize that some of the funds that you've invested into don't continue to do well. Okay, and so definitely, that's a fund that you can drop, because anyway you need to consolidate your scheme.
All right, thank you so much, Shashi, for sending us your question, and hope you make the desired changes as suggested by Anil. We move on, and we have Vivek on the phone line with us from Mumbai. Hi, Vivek, how are you doing?
Hi, I'm good. Thank you.
Thank you so much for sending us your question, and you've sent us your investment details also. HDFC Mid-Cap Opportunity, Mira Asset Mid-Cap. You also have Motilal Oswal Mid-Cap and Small Cap, Nippon India Small Cap, and Nippon India Multi-Cap also. Okay, so you think your portfolio is very volatile in terms of risk.
Yes.
Your portfolio right now doesn't matches with your risk profile. Is that what you're saying? So you are a moderate risk taker.
Because I am currently at the age of 30. I am working in an IT background, and I have a decent kind of good salary package. So this is fine for me, but this by looking up at my current portfolio, because I don't have any prior background during this investment or mutual fund background. So I'm a completely new in this world, in this investment world. So looking at my current portfolio, which is a kind of 3 mid-cap, 1 multi-cap, and 1 small cap, is a kind of completely volatile kind of portfolio.
So a better diversification strategy. Okay, a better diversification strategy is what you're looking for. And looking at your age, I think you can take maximum risks, but then a well-diversified approach is always recommended and is the best. You also realize that you need to add some flexi cap and ELSs in your portfolio. And what would be the definition of good return, if you could just quantify it and give some number to it, because it will be easier then for Anil to maybe tell you to increase your investment amount, or what kind of corpus you would be able to achieve after 5 to 10 years. So what's the corpus that you're looking at after 5 years and 10 years, if that's how you want your investment amount to come into you?
I don't have any specific figure in my mind currently, but I can take up I have the time period of 10 to 15 years for such kind of investment. So I'm looking for a kind of long-term investment strategy.
Okay. So So just help me understand, are you looking at a goal after 5 years and at a goal after 10 years? Are there two goals?
Yes, like I'm looking for a kind of 5 years and 10 years. 10 years is also fine. Like
5 years and 10 years, got it.
Yeah.
What's the total SIP amount?
I have currently invested around 10K, like 10,000.
Okay, okay. 10K. And you started this investment when?
In this month only. Like I have gone through some like YouTube videos and some research, and I did this by my own. So,
Got it. Got it. Okay. All right. Let's quickly connect with Anil. Anil, I tried getting as many details as I could for you for better planning. Is there anything else you want me to ask Vivek, or that's all? You can just go ahead quickly with it.
Yeah, not a problem. I think that's fine. So first of all, I think congratulations to him. He has done his research. He's gone across, and it's not unexpected that he's landed up with mid and small cap, because at this point of time, if you look at past returns, you have got into all of them. Yes, definitely, it's a good thought that you also have, and that's also my recommendation that you diversify, because sometimes it's very difficult to get in and out of market cycles. So it's important to be disciplined in your approach and diversify across different market cap segments. So I think flexi cap that he spoke of is definitely something that one can consider. And he also asked what are the types of funds that he can look at. I think he can consider from either HDFC Flexi Cap or ICICI Approved Flexi Cap Fund. Now, what has become important is how much he spreads out across the mid small cap and let's say the Flexi Cap. He can also choose to have a large cap possibly at some point of time. So based on that, he can choose whether one fund or two funds, possibly even look at as much as 30% to 40% of the allocation sort of going into non-mid and small cap category. On the ELSS category also, he wanted some inputs, and so I think ones which have been consistent and also manage risk a little better are like SBI Long-Term Equity Fund as well as HDFC Tax Saver. I think on the ALSS, I think he can choose from one of them, okay, depending on his comfort.
All right, I think that's very well sorted. Vivek, did you hear the recommendation? Is there anything else you want to ask? See, you really need to redefine your goals. Maybe just look at them and give a ballpark figure or a corpus amount that you might want to, accumulate, because that will give a structure to your fund portfolio exposure also. Anything else you want to ask, Anil?
Just a final question. Like I have around 3 mid cap funds as my portfolio.
Okay.
One multi cap and one small cap. So in between these three, which one is I can switch, like, because 3 mid cap is I think is a kind of volatile.
Over diversified. Okay.
Yes.
Let's just talk more on this. Yeah. Okay. Is there anything else? Because I'm running out of time actually, so I'll quickly want to connect with Anil for this. Okay. Anil.
He can drop probably the Motilal Oswal. The issue that's been a little volatile fund. So I would go with maybe the HDFC mid-cap opportunities and the Miri Asset mid-cap and sort of go ahead with that. I think that's the best thing to do.
All the best, Vivek, with your financial portfolio. And with that, thank you so much, Anil, for being on the show and helping our viewers with their financial portfolios today. And it's a wrap on the Money Show today as well. But then I'm going to leave you with our WhatsApp number and email ID where you can send us your portfolio-related queries. 865-797-4571 is our WhatsApp number. The email ID is themoneyshow@etnow.tv. All you have to do is just send us your portfolio details and we will get it answered. And in fact, also make you have a conversation with our experts if in case you join us live. But it's the only show where we think about your financial goals and give you the right strategy for it through our experts. Thank you so much for watching. Goodbye.